Good day, fellow investors. Today we're going to discuss the true cost of inflation. The situation is that the debt is high, the solution is inflation. That comes at a cost that not many are aware and keep it in their minds. And then there is a long-term solution, not an immediate hedge, but investing way to, let's say, not lose that much through that cost. This was the recent news as I prepared this video, so debt limits, Congress, votes, etc. This is just smoke to blind you from the reality behind everything. Limits, this and that, that's just noise. The reality is that there is a lot of that with what will start this video. We are in the part of the cycle, the debt cycle, the long-term debt cycle that is just getting bigger and bigger because whatever happens, whatever issue there is, the solution for the last 40, 50 years has been more money, more debt, more liquidity. Sooner or later, and we have just seen the first glimpses of it, that results in inflation, which comes at a cost. Because all you need to look at is the situation of, this is the US, but it's not much different in Europe and in the rest of the world. 2023 federal budget, borrowing 23% of spending. And the projections are that the government will just keep doing that forever. This number here was 103 just a few months ago. The guys at the Central Bureau Office of Statistics got a little bit smarter, and now they understand that this will go just higher and higher. Also, the projections are very rosy, so I wouldn't be surprised to see it here. And plus, they are not even taking into account entitlements, future debt obligations. This is just as is now, and to cover net interest that is going higher and higher, it will be a tricky situation to cover. If we look at the global bond market, developed markets, US, corporations, everyone is highly indebted because that was the name of the game. Cheap debt here, low interest rates allowed for an explosion in debt, especially over the last 20 years. And especially since the 2008-9 financial crisis, keep in mind that crisis was a debt crisis. So because of too much leverage, too much banks involved into housing, into this, and we had the greatest financial crisis since 1930. But what was the solution? The debt pile in the last 10 years, 12, 13 years, doubled because they printed more money, more debt to solve the previous debt situation. So if you are a junkie, you need more heroin to get better. That is the prescription from the doctor. And just look at this, 1981, 40 years ago, the debt of the federal government went up 30x. Okay. That's where we are now, and for now there is no solution then, this just going higher and higher. How is this possible? Well, inflation is the solution. And the solution to the debt pile, the only solution out there is inflation. Let's say 100 years ago, you give someone $100 and you tell the person to return the $100 100 years later. Again, just nominal value $100. The thing is that thanks to inflation, the real value of those 100 is now, I don't know, let's say 1. So because of inflation, if you lended the money, you lost, I don't know, 99% of the purchasing power of that dollar over time. That's why governments go on borrowing sprees, because they think that inflation will make the debt a problem of tomorrow, but a smaller and smaller problem over time. And there are countries, Italy has recently issued 50-year bonds, then it has issued 100-year bonds, and you see the yield going up and down, so a lot of trading around those bonds. But if your pension fund bought that bond, and pension funds usually do that at 3%, it has already lost due to inflation in the last few years, which was 10, 11, 20% likely accumulated. It has already lost a decade of yield in purchasing power. So that was stupid by anyone buying. Of course, we just discussed the pension fund crisis that will come in the next 10 years. And you can check that video. I'll put the link here also in the card. And that crisis will even further put pressure on government finances. So, how it will be solved? With more debt or inflation, which will limit the purchasing power of your future income, i.e., pension. So, by targeting, their target is 2% inflation. The last few years, it was, if you accumulated 20%, because they missed a little bit the target. But it's never a linear thing. They cannot keep that linear. It's up and down, crisis, big inflation, and now we are again in big inflation situation. Now there is the question of what is the cost of this mechanism, of this solving debt, printing money, allowing for inflation, and is it worth it? You have to always keep in mind that when someone borrows, they should at least try to do something with it. If they build something, a railroad, something that creates value for the next 100 years, and that value then, if there is inflation, the price, the value of that goes higher, at least it is a productive asset, then you can say, okay, it is smart to do so because it incentivizes investing, because you need to invest your money so that you don't lose the value, the purchasing power through inflation. However, if you look at inflation over the last few years, sometimes if you print too much, it gets out of hand. 5, 8, 6, and then you quickly get to 5, 8, 6. And over the last 3 years, if I take the 5, 8, and 6, and each year deduct 5%, 8%, and then 6%, you lost 18% of your purchasing power. So whatever you had in your pension fund, IRA, whatever, if you didn't make 20% in the last 2 years, you lost 18% of your purchasing power. My pension fund on top of that lost 11% in the last 12 years. So my pension is 30% lower in purchasing power. That is the reality. The money is gone. Simply, the value there is gone. The government, okay, they have increased their revenues because of inflation, but also their costs, because government employees want their pays, pensions indexed to inflation. So there is not much of a benefit there. But they keep playing the game, and as long as they can keep borrowing, they will keep doing that. 2% inflation, I think the cost is worth it, but you need to keep things under control. You need to not borrow as much, 5, 6% budget deficits. Of course, everybody wants more. You want more. You want to pay less taxes. You want more incentives, more entitlement, better healthcare. And everybody is constantly pushing. That's the nature of the environment we live in. That's the human nature we have in ourselves. And that all reflects in the environment. So, of course, keeping it all stable, then the cost would be worth it. But we as humans cannot keep things stable. We need to exaggerate, go above, beyond the limit, which then comes at the costs later, which is not a sustainable cost. So I'm pretty sure there will be more inflation ahead. Now it will be subdued. Then in 2 years it will be again 10%, because that's how we play the game, and there is no way of going around that. The Fed cannot lower its balance sheet. The next crisis, it will have to print more. So it's likely that we will see ups and downs of inflation for the next 15 years. Issues, there will be more money printing, more taxes, depending on what the government wants. If they say, oh, we can just print money, we don't need to raise taxes, So that is an unknown there, but also a possibility. So ahead, we have enjoyed great liquidity, great financial times over the last 15 years. The situation will be trickier ahead because of inflation. And now the question is how to invest, how to position yourself. The first thing I would say, you have to keep in mind this is a long game. This is your financial life game that lasts 40 years. Last year, when inflation was at 10% and going up, I would get 10 emails a day about, Sven, how can we invest to protect ourselves from inflation? The last months, I didn't get any emails about inflation. Everyone is looking, oh, these cheap stocks, but nobody talks about inflation anymore. That's how the human mind works. Everyone wants the solution to the current problem. That's usually the most expensive things. All those that send me an email, Sven, let's invest in commodities, are down 20, 30, 40, 50% now. So why not think about the financial perspective of your lifetime from a 40-year, 20, 30, 40-year horizon? If you take 20, 30 years, okay, inflation will likely be higher somewhere in the next 20, 30 years. Then you know, okay, how can I invest so that when it happens, I take advantage? When it has already happened, it's too late to take advantage. Don't be the fool. Like all of those that asked me in 2022, saying how to protect from inflation. 2021 was the time to do that. So to protect yourself from inflation, you have to build your own inflation-protected income. Governments, they just took 20, 30% of your purchasing power, of your future of income by allowing for inflation. They will do that again. So don't count on them. Build your own income. How do you build that? You buy productive assets at the right price, the best you can do. Everyone is looking, oh, I want to buy the stock or the house that will double in value tomorrow. Some of you will do that, but most will not. So buy things that you know that are okay for you, for your strategy, and do the best you can do. If you look at the price of electricity, so you think utilities, it was, I don't know what, 3 cents per kilowatt hour. Now it is 15. That is 5x. So that is some kind of protection from inflation if you buy productive assets. Of course, on this channel and on my research platform, you can check it out. I invest in businesses, look globally for businesses that will give me that productive power, inflation, long-term protection, not tomorrow. And that's what I can do. I think that is something smart. Did it with real estate equally, and you just position yourself in a way that if there is inflation tomorrow, we will do okay. We will be well off, as Warren Buffett says. I think that well off target when it comes to investing is the holy grail that few appreciate, few chase, therefore there is the opportunity. Thanks for watching. I'll see you in the next video.